Well, ladies and gentlemen, we are just a few days away from the presidential election being announced. And if you thought things were getting crazy, just wait, because I believe it could get even crazier. A lot of our market indicators was pointing to the end of October to basically the beginning of December being a pretty volatile time. As we ended October, we saw that pretty significant market sell-off, a nice rebound on Friday. But here we go into another bunch of things for the market to digest, and the election just being one of them. Alan Lichtman versus Nate Silver, both of these guys have been fairly accurate in predicting recent elections. They use different methodologies, and they are not agreeing on this at all, which is telling me that the country's probably divided as well. In roughly a couple days, one of these guys is going to have the bragging rights. Whose model is going to be more accurate? Now, Lichtman has projected 9 out of the last 10 presidential elections correctly, and he has a W coming for Vice President Kamala Harris. But Silver is no slouch either. He's projected a lot of the underdogs, including Trump beating Hillary Clinton, and he is standing by his prediction that Trump will most likely win here. Now, Silver is questioning Lichtman's process on assessing this election, saying that he didn't use the 13 key attributes correctly, and these 13 key attributes do favor Trump. Now, Lichtman is stating that Silver's process does not account for how campaign messaging or major events like debates influence voter sentiment. So Lichtman made this prediction a long time ago and is sticking by his guns, because the only thing that would really derail Kamala from winning in Lichtman's point of view would be a major foreign policy event occurring. Tough to understand this one, because I do think that there is some serious major foreign policies that are taking place here. And so we have Silver going for Trump and Lichtman going for Kamala Harris. Who do you think's going to win this election? Leave a comment down below. And does it really matter? I think the knee-jerk reaction is going to be a pretty significant sell-off for the market regardless. I think the market's looking for a reason to correct, and I honestly don't think it matters who's going to get elected here. I think we could see a sell-off. I do think, however, there could be a stronger sell-off on Kamala's winning, just because we've seen rallies in the small caps, and a big part of that could be attributed to Donald Trump's policies. And so I do think small caps could get hit a little bit harder here. I guess time will tell on how all this will play out. Now let's talk about what's really driving this economy, and it's been a strong labor market. But what did we see? Jobless claims slip as impacts from storms and strikes ease.
Rick Santelli standing by at the CME in Chicago with breaking economic data. Rick, the numbers, please. 1-800.
Yeah, well, all you have to do is look at yields. Yields are jumping. And why are yields jumping? Because we expected initial claims to be lower. We have hurricane issues. We have Boeing strike. We have layoffs at Boeing. Washington State claims should go up, but they're going down. 227,000 on initial claims. 227,000. That's the lightest since the last week in September. And those last weeks in September were the lightest since May of last year. May of this year.
So this has actually been my thesis going into this year, is that the jobs are going to remain strong. And even though we had storms hitting the coast of Florida and we had Boeing strikes, the claims are remaining pretty muted. In fact, the job market's remaining hot. But if you remember what I've been telling you, is seasonality is going to keep this job market strong. It's going to be the first quarter of next year where we start seeing the cracks. And I do think that we're going to see them very, very quick. The majority of our job market, our labor market, is based on government jobs and service bases, which means that if the consumer stops spending, we don't need to hire as many people. And if we go through a weak November, December timeframe, the season, we're going to see a lack of hiring and actually probably more layoffs going into the first quarter of next year. So with the job market remaining hot, we're actually watching the 10-year Treasury remaining stubbornly high, and this is going to cause a lot of problems for especially small cap companies that need liquidity at a reasonable price. They're not getting that. Residential real estate is going to be in some sort of influx with higher interest rates. We talk about most of our debt society being based on the 10-year Treasury here. We can see that this is going to cause a lot of problems. We have a presidential election, and I do think the job market is falsely propped up due to stimulus and not true economic growth. So on November 5th, we obviously have the presidential election. We're going to get ISM data on the 5th as well, PMI data on November 6th, initial jobless claims on November 7th. Then we have an FOMC meeting on a rate decision, then a Jerome Powell conference, and consumer credit updating. So when we talk about next week, it is going to be a nutty week, ladies and gentlemen. This might be one of the most volatile weeks that we've seen in a significant amount of time. And because the market has rallied to what I would call pretty expensive levels here, the volatility should be a little bit more elevated than normal. I think we could see the VIX actually spike at pretty extreme levels. There's definitely many opportunities for things to get a little bit crazy, as you guys see by the data points coming up. And all these things are actually setting us up for the next year. When we talk about initial jobless claims coming November 7th, I'm really curious to see what the numbers are going to be this time around. Then we talk about Jerome Powell. Is he going to cut? Is he not going to cut? And with a new president in the chair, what could we see as far as dynamics from the Federal Reserve and the new sitting president? So many things for the market to digest, and definitely the market has been resilient. But I also have a lot of questions to how this market has reached new highs. When I look at this economy, it's not being driven off of things being built and manufactured in the United States and organic growth. This has been the stimulus packages being dumped on consumers and many service hirings taking place, many government jobs being created. And none of that is really fiscally responsible, because in order for those jobs to keep kind of maintaining the growth that they're on, we have to keep stimulating at a ridiculous amount. And I just don't know if that's going to come with the deficits that we're running and with that 10-year treasury creeping up. Now, Goldman Sachs made a prediction that over the next 10 years, we could see 3% returns on the S&P 500. This is obviously much lower than the 13 average rate of return we've been seeing on a yearly basis in the S&P 500. And what they're contributing this to is obviously valuation being number one using the CAPE ratio, investor behavior being number two. And if I were to guess what the main driver of this is going to be stimulus packages not being passed down directly to consumers. Whether it's the student loan moratorium, whether it's the IRA Act, or whether it's the CHIPS Act, there was many packages passed over the last 8 years that created a tremendous amount of spending for the consumer, bolstered government jobs, and bolstered healthcare because of the COVID package that was passed. And all those three things are not going to be sustainable going over the next 4 years. And that's why I think it's going to be a rough patch here over the next few years. And that's why I've been talking about taking profits into the end of this year and looking more defensive, names that pay pretty substantial dividend yields that are safe, and also possibly looking at the longer end of the yield curve, because if we do go into a recession, you could be locking in a long-term high yield if we look on the longer end of the yield curve, and you also get appreciation on the bond price. So as yields go lower, if we do go into recession and if the Feds do cut drastically, then the price of those bonds are going to be worth a lot more. So you have the capital appreciation side as well. People tend to forget this. So I do think longer end yield curve is getting interesting as the yields picking up here, and we're going into more and more uncertain times, because we could see those yields absolutely dip if we go into a recession or if there's a tremendous amount of uncertainty. And when we look at what the annualized rate of return is for Goldman Sachs, they're predicting right around 3%, and JP Morgan's predicting right around 6.7%. So if I were to kind of look at things as a whole here, I would be sitting on a substantial amount of cash. I'd be looking at the longer end of the yield curve. I'd be looking at defensive sectors that pay nice dividends, because if it is a volatile time frame, at least you have some sort of yield being created in your portfolio. So look for defensive names that are growing their dividends. Look for longer end of the yield curve if it starts creeping above 4.5%. If we get close to 5% again, I think you really have to be looking at this, because if we go off of Goldman Sachs and JP Morgan, basically the S&P 500 doing under 7%, then why wouldn't you lock up a risk-free 5% that has an opportunity to actually outperform if we do go into recession, because yields would collapse, forcing the price of those bonds and treasuries to actually increase in value. So then you can resell it to the market for a substantial gain, just like a normal equity. As always, ladies and gentlemen, this is just my 2 cents. It is going to be a volatile week. Let me know what your thoughts are down below, and we will see you all in the next one.